The average real estate investor loses $12,000 a year to taxes they never needed to pay. Here's the uncomfortable truth. Most real estate investors are legally allowed to pay almost zero in taxes, but almost none of them do. Not because the strategies don't exist, because nobody taught them. The U.S. tax code has dozens of provisions written specifically for real estate investors. Depreciation, 1,031 exchanges. Cost segregation, opportunity zones, the short-term rental loophole. In this video, we're covering every major strategy with real numbers, so you know exactly which ones apply to your situation. Whether you own one rental property or 20, this analysis could be worth tens of thousands of dollars a year. Let's start with the scale of the problem. The median U.S. real estate investor earns about $28,000 per year in rental income. At a 24% federal tax bracket, that's $6,700 in taxes before state taxes. But investors who understand the tax code, some pay zero. The IRS tax code has over 2,000 pages. Roughly 400 of them contain provisions specifically favorable to real estate investors. The question isn't whether the strategies exist. The question is whether you know which ones to use, and in what order. Depreciation is the most underused deduction in real estate. Here's how it works. The IRS assumes a residential building loses value over 27.5 years. If you buy a $400,000 rental property and say the land is worth $80,000, the building value is $320,000. Divide by 27.5. That's $11,636 per year you can deduct from your taxable income, even if the property is actually appreciating. At a 24% tax rate, that's a $2,700 annual tax reduction per property every year for nearly 3 decades. A portfolio of 5 properties generates over $58,000 in annual depreciation deductions, almost $14,000 in tax savings annually, without spending a single extra dollar. Section 1031 of the Internal Revenue Code is the most powerful wealth preservation tool in real estate. Sell an investment property, reinvest the proceeds into a like-kind property within 180 days, and defer 100% of the capital gains tax. Indefinitely, you can exchange again and again and again, theoretically forever. The rules: identify a replacement property within 45 days, close within 180 days, and use a qualified intermediary to hold the funds. Fail those rules, and the exchange collapses, you owe taxes that year. Done correctly, a $200,000 gain that would cost $47,600 in federal taxes stays fully invested, compounding in your next property. That's $47,000 working for you instead of the IRS. Even when you do sell and pay capital gains, the rate matters enormously. Short-term capital gains on property held under 1 year, taxed as ordinary income, up to 37%. Long-term capital gains on property held over 1 year, 3 tiers, 0%, 15%, or 20%, depending on your income. A married couple with $94,050 or less in taxable income pays 0% on long-term capital gains. 0. Even at the highest bracket, income above $583,000, the max rate is 20%, roughly half the ordinary income rate. The strategy: always hold properties for at least 1 year, harvest losses in bad years to offset gains, and know exactly which bracket you're in before you sell. The entity you use to hold real estate affects taxes dramatically. Direct ownership. Simple, but all income flows directly to your personal return. LLC taxed as a partnership. Pass-through treatment, liability protection, no double taxation. S-Corp can reduce self-employment taxes if you're active, but adds payroll complexity. C-Corp almost never write for rental real estate, Double taxation destroys the math. The critical variable: are you passive or active? Passive investors can only deduct passive losses against passive income. Active real estate professionals, defined as spending 750 or more hours per year in real estate, can deduct unlimited rental losses against ordinary income. A high-income earner qualifying as a real estate professional can shelter 6 figures of W-2 income with real estate losses. That threshold changes everything. Three advanced strategies that sophisticated investors deploy. First, cost segregation. An engineering study that reclassifies building components, carpet, fixtures, land improvements, from 27.5-year depreciation to 5 or 15-year schedules. The result: dramatically accelerated deductions in year 1. A $1 million property with a cost segregation study can generate $150,000 in first-year depreciation versus the standard $32,000. Combined with bonus depreciation, this creates massive paper losses to offset other income. Second, opportunity zones. Invest capital gains into designated census tracts, defer the original gain, and pay zero tax on new appreciation held 10 years. Third, the short-term rental loophole. If your average guest stay is under 7 days and you materially participate, typically over 100 hours per year, losses become non-passive, meaning doctors and high-earning professionals can use them to offset W-2 income directly. If you invest internationally, the tax picture shifts. The U.S. taxes citizens on worldwide income, but foreign tax credits prevent true double taxation. You pay taxes to the foreign country, then credit those against U.S. liability. The key: tax treaty countries. The U.S. has treaties with 68 countries, with provisions reducing withholding rates on rental income from 30% down to 15% or less. Countries operating territorial tax systems: Panama, Paraguay, Georgia, UAE, only tax locally sourced income. UAE has zero personal income tax. Panama exempts foreign source income entirely. For U.S. investors living abroad, combine these structures with the foreign earned income exclusion, $126,500 in 2024, and the tax optimization potential expands significantly. One critical rule: always work with a CPA specializing in international real estate before executing cross-border structures. Here's the action plan based on your portfolio size. 1 to 2 properties. Track every depreciation dollar. Plan holding periods for long-term capital gains treatment, and document all expenses meticulously. 3 to 10 properties. Get a cost segregation study on any property over $500,000. Evaluate whether you can qualify as a real estate professional, and use 1031 exchanges every time you sell. 10 or more properties. Real estate professional status combined with cost segregation becomes your primary tax engine. Hire a real estate CPA, not a generalist. The 1031 exchange is your default exit strategy, not selling outright. The bottom line: real estate is the most tax-advantaged asset class available to U.S. investors. The code is literally written for you. The only question is whether you're using it. Subscribe to Property Ranked for data-driven real estate analysis every week.